So there's a very indirect linkage, what's known as vol targeting. But the thing is, in my opinion, this was a trade that got way too crowded. I'll speak to the manipulation claims later. But essentially, what I think happened last Monday is a small example of what happened in Black Monday of 1987. So in Black Monday 1987, you had what was called portfolio insurance, where people were basically forced to sell because the market was down. And as the markets fell, people had to sell more. That's essentially what happened with these VIX products, where they were short VIX futures. As VIX futures rose, they were forced to buy even more VIX futures, and eventually they moved the market against themselves. So to me, it's a very simple story of, number one, too much leverage. You had a product that could be wiped out if VIX futures doubled in a single day, which is very easy from low levels of volatility. Too much leverage and too low volatility.
Pravid, so here's my question, though. All of that being said about this the volatility products, is the only reason that stocks declined because they're programmed, by algorithms or whomever to do this, to say, oh, when the VIX goes up to 30, it's a sell? Was there any other linkage between those two as far as you can tell?
So there's a very indirect linkage, what's known as vol targeting. But the thing is, vol targeting programs aren't forced to sell everything in a single day. So there are some programs that say they want to target a certain volatility of their portfolio. If they feel that the market has become more volatile, or I shouldn't say they feel, but they observe that they measure volatility to be higher, then they may in turn go and liquidate some of their portfolio to match that new target volatility. But importantly, most of them don't look at the VIX. They look at the actual movements in the stock market and use that to determine what they think volatility will be going forward.
Yeah, I mean, I think just to build on these points, you have these products that we should remind people were meant to mimic the inverse of the single-day move in the VIX. So this was essentially engineered in a way that in this environment was going to implode and skid off the road. So the other thing is the general market backdrop, which was very compressed volatility, assumptions of compressed volatility continuing, and then a relatively small market decline creates an outsized up move in measured volatility. And that does, it's sort of the pebble in the road. You're at high enough speed, you do a spin out. And that seems to be what happened.
All right, so here's my question. Were these instruments doing what they were supposed to do, or did something break down?
That's the other. They were, largely speaking, doing what they were supposed to do. There is a lot of talk about what exactly happened after the close of regular trading on Monday when the VIX continued to spike, and you had everyone sort of knowing or assuming that these instruments were going to be continuing to be forced buyers and were teetering on the edge of having to essentially liquidate.
We pretty much knew, Kramer has said it was going to 50 Tuesday morning.
Exactly.
And where did it go Tuesday morning? It went to 50.
Right. And so you kind of knew at that point it was going to happen. And so it did create this talk that there was sort of a raid, and some hedge funds tried to opportunistically help this along if they could. But it's totally different from these allegations that the statistical calculation of the VIX is somehow manipulated, which I think remains